On today's show, 3 questions. Number 1, what's the Fed's new catchword? Number 2, why are prices still high if inflation is slowing down? And number 3, do you even lift, bro? Let's go. Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Will.
And I'm Rabih.
Yeah, you are. Hey, guys. We're going casual today. Rabih, you took your hat off. I thought we were going to be hat buddies today.
Here you go.
There it is. Okay. I've got my Eagle sweatshirt on in solidarity for their horrible choke of a loss last week. I still am not over it. So
it was bad.
I probably shouldn't be wearing it, but I've got to still show my support, even though I was so mad last week. It was such a bad loss. But let's jump right in. Rabih, what's the Fed's new catchword?
Yes. So it seems like every time there's a regime switch in how monetary policy is being implemented, there's a catchword for it. Like, remember the idea of transitory, and then the idea of bringing inflation back to the 2% target. And now we have a new catchword, which is recalibration. I think Jerome Powell mentioned it like 8 times in one sentence on Wednesday during their Fed speech.
Is this like the nerdy financial equivalent of like Twitter trends or like social media trends?
Oh yeah.
Like the catchwords of the day for the Fed.
I kind of like the word. It's a good word.
Recalibration.
Getting it dialed back in. Yeah, dialing it back in.
Yeah.
So a lot happened since we last talked about the Federal Reserve and the anticipated interest rate cut. We were because we didn't record last week. We recorded 2 in a row the week before. When I wanted to look at the probabilities of what we thought interest rate cuts were going to be. And when we first met on the podcast, the probabilities were 70% towards a 25 basis point and 30% towards a 50. And then the week after, so earlier last week, that probability shifted to a 50-50. And the day before the Fed decision, the probability actually shifted to 60% of a 50% cut, a 50 basis point cut versus 40% for a 25 basis point, which kind of tells us, if you've been following the market, although the 50 basis point cut came as a surprise, so many people, a lot of articles were out there, even like articles saying whether it's politically motivated. It seems like the market knew that the Federal Reserve is going to be cutting 50 basis points.
The market always knows.
A couple of days before they did. And we'll get into kind of the reasons for why they chose a 50 basis point. But like at the surface level, let's just remember that they're not going to be meeting in October. So, and they do not want the market to wait until November, which is after the election, for them to actually make a decision on a further increase. We're so used to saying increase, on a further decrease of interest rates. So in a sense, they're just playing it safe by cutting a lot ahead of time, simply because they're not going to be able to make a decision until November. And given that the market was already saying, hey, you guys are too late, you should have cut in July, type of thing.
Well, that's what I was just going to say, Rabih, is we've talked about this previously, that they probably are a little bit more aggressive with this because of what, and you mentioned transitory being one of the catchphrases of like a few years ago, all of the debates going back and forth about inflation being transitory or not. The Fed held the line on that, if we remember, a lot longer than anyone else. They kept saying transitory, transitory, transitory. Everybody in the market was yelling, no, it's not. And I think maybe this is a lesson learned. I guess the worry maybe being, and I'll throw this out to you, like, have they swung it too aggressively the other side because of not wanting to be too late on it? Like, what are the risks here of going too aggressive with this?
If they go too aggressive, inflation might come back. And what we mean by too aggressive is that they start cutting interest rates left and right? So actually, I watched the whole press conference out of my own nerdiness. And there was a very interesting theme about him. Oh, you're going 50 basis points right now. What happened to the path that you laid forward? And he kept referencing that our patience has paid us dividends. the reason we're allowed, and here's what I'll go into what he means, here's why he's not afraid inflation is going to come back even with a 50 basis point cut. He said the rest of the world, the developing markets, have cut interest rates multiple times so far, but us waiting, being data dependent that we are, us waiting and being a couple of months after the other developed countries have given us more confidence in the data that inflation has really gone towards a range where it's under control. Now it's like 2.2 where their target is 2. It was up in the 6s or 5s based on their core PCE indicator. So he said the fact that we waited vis-a-vis other developed countries has paid dividends in our confidence, and now we're able to recalibrate back to a more neutral pace where we can keep unemployment in check in a sense. So the market, actually the day off when he said on Wednesday, the market didn't really react well. It closed like around negative 0.3% on average across the 3 major indices. But then yesterday on Thursday, it was a big celebration.
Go time, baby.
Yeah, everyone's happy. And Dow all-time highs, gold is all-time highs.
Where is it at as of today, Rabih? I haven't looked. Is it reacting positively again?
Well, today is a Friday. A lot of options expire. There's a lot of noise in trade data. A lot of margin holders would want to close their position ahead of the weekend. So Friday data is very noisy. We're kind of flat. We're a little bit down, but you can't, unless there's a release of news, Friday is very noisy to actually make estimates out of that.
Everyone's hanging out on Fridays. They don't care. Yeah.
Friday.
Yeah.
So, but I think the most exciting part is that they finally gave us a new summary of economic projections. This is their projections. Every quarter they issue it out, and the change from one quarter to another says a lot about what the Fed is doing and where they stand. So they gave us a new summary, which tells us what their expectation of the real GDP is going to be for this year and next year and the one after, the unemployment rate, the PCE inflation, the core PCE inflation, as well as the projected path of their interest rate cuts. So in the June projection, they had interest rates staying 5.1 for the remaining of the year. However, now with the September projections, it seems like they are communicating that we're going to end the year at 4.4% interest rates, which means there's still a half basis points remaining. So they've already cut 50, half percent remaining. We already cut 50 basis points this week. And then according to these communications, it's probably going to be another 25 in November, another 25 in December, in a sense, to ease the market, according to what they said right now. They do not think there's going to be a significant change on the GDP. We're still going to be running at 2%, which is where you want your GDP to be running. That's the real. So there's 2% real, 2% inflation. You're running nominally at like 4%, which is a very healthy number for an economy as big as the US. Inflation, they see it slowly, but they're going to the 2% target at 2.3. And then he said if it takes a year to get to the exact 2 number, they're not in a rush. They're really going to play this well. So they win the soft landing argument in a sense. But the elephant in the room is unemployment rate. And in the June projection, they said that unemployment rate is going to stay for 4% until the end of the year. And we talked about it multiple times, especially as the data started coming in. We had 4.1, 4.2, 4.4, and then dropped back to 4.3. The Federal Reserve was like, you know what? I'll just reset. I'll say the unemployment rate from now until the end of the year is going to be 4.4%. So they just took what the market is in right now and considered it their base scenario, which is fascinating because they just cut interest rates. And we've been saying through all the phase when inflation was there, interest rate effect is, what's the word? Like it takes time to kick in. It takes a lag. Like if you cut interest rates today, the economy is not gonna feel the boost and the easing of monetary policy. It takes
time for that to actually take effect.
It takes time. And we used to say like 18 months, right, for the a hike or a cut to be felt into the economy. So they're saying that they just cut interest rates this week, and they're expecting unemployment to stay at 4.4 from now until the end of the year, which is where we are at. And I think that is going to be a moving target, and that's what the market, like whether it was the interest rates or equity prices, are going to be reacting most to when news come up. Whenever we have a data that's going to be related to unemployment, given that this target, they like cornered themselves. They're saying it's going to stay at 4.4 till the end of the year. This is where we're going to see some volatility. We are at 4.4. We're going to be getting reports on initial claims, outstanding claims, and unemployment rate a lot from now until the end of the year, at least 6 or 7 reports. So we'll see how the market will react as these come forward. There was a question during the press conference by the New York Times, which I thought hits the nail on its head. Here's what they said. They said, your economic projections today see the unemployment rate climbing to 4.4 and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it typically doesn't just stop, and it continues increasing. So I wonder if you can walk us through why you see the labor market stabilizing, et cetera, et cetera. And he gave a very political answer, which kind of opens the market's eyes. It's like, oh, this might be a moving target. They might have in the December change what they think unemployment is going to be. And yes.
Oh, sorry, Rabih. I'm so glad you brought that question from the New York Times, because as you're going through this, I'm sitting here thinking, tell me if I'm wrong here, but I'm sitting here thinking it's kind of, maybe this is cynical, but this is kind of lazy of the Fed, in my opinion. I think it's kind of them admitting we have no idea. Yeah. It's 4.4. Great. Let's just keep it there. They were off what they originally said of 4. It's at 4.4. What are they going to say? We actually think it's going to go to 6 by the end of the year. They're not going to say that. So I'm actually really glad that they were pressed, and it sounds like he gave an answer that confirms what I'm thinking as you're going through this, of him just saying, this is him saying we don't know, right?
Yeah, he kind of says we don't know. And when they pushed hard on it, he said, well, you guys are used to seeing unemployment rates of 3.5%, which is really below historical averages. Our average is 4.4, 4.6. And this is just very healthy. This is a very strong, healthy labor market. He kept reiterating that a 4 level is very healthy labor market. And in terms of the answer that he gave her to that specific question, he said, our intention with our policy move today is to keep it there. So you can say that about the whole economy. The US is in a good shape. It's growing at a solid pace. Inflation is coming down. The labor market is a strong pace. We want to keep it there. That's what we are doing. He's trying to give a sense of control, but his data and his projections tell us that there's no sense of control. And just the fact that there's this small gap in our projection, it all makes sense. Yes, the economy is strong. It's going to stay at 2%. He's going to be cutting interest rates, but are you really going to convince everyone that unemployment is going to stay at 4.4? The fact that there are mixed opinions on that creates uncertainty. And with that uncertainty creates volatility in prices. So this is where we think, based on Fed communication, volatility is going to be coming from.
He didn't use the word recalibrate either in that sentence.
No, he didn't. But he used it in his opening statements a couple of times and in many, many questions.
That means he's not confident. Yeah, if he's not using it in that statement, he's not confident then.
Yeah, and let's be clear, we don't, in no way would any of us sit up here and blame or say you should know exactly what's going on. I think we're just kind of seeing it for what it is, which is just like everyone else. He might have more information. His team might have more information than the average person, but he also doesn't know. And that's what I think kind of what, that's kind of what he's saying. And
we're all along for the ride.
We're all along for the ride. And I can only imagine the position he and his team are in to have to navigate this and then articulate to the world, trying to articulate a position of control. I get it. We totally get it. And the position he's in is so tough. I think for what the situation has been over the last few years, we can't say anything other than they've done the best they possibly can. We'll kind of see where things go from here.
We played Jenga a lot with my kids Feels like a massive game of Jenga.
Oh, yeah.
And he's like slowly pulling out the
It's
little
so
blocks.
true.
Yes.
Yeah. It's like the time in Jenga was like the first half slide's really easy. And also you get that last half and you're like, oh my gosh, this actually might tip the whole thing over.
Right.
Jenga, that's a throwback. Awesome. Rabih, anything else that you have on this?
Nope.
Okay. Recalibration is the catchword of the day until we get a new one from the Fed. This actually goes perfectly, I think, into, Will, your topic, the question being, why are prices still high if inflation is slowing down? I love that you brought this up because I think this is probably on people's minds, kind of like this.
Yeah.
We're hearing in the headlines inflation's coming down, but it doesn't feel like that on the street. Tell us what your thoughts are on this.
This is probably just good finance 101 to go over what, kind of this means. And I saw something I follow a lot of like my X, I think it's called now, X. Yeah. My X follows are like a lot of finance people. So I get fed finance stuff, nerdy finance. Yeah. But there's a lot of good memes. So that keeps me going. But I saw this thread that was talking about like this exactly. Like if inflation's slowing down, why is my grocery bill or why is my McDonald's bill? Like, why are this all like super high still? And it doesn't feel like it's slow. Like, and I think it's just a kind of a misunderstanding of what slowing inflation means. So there's a couple words that we should just probably define. Inflation is when prices are going up. Disinflation is when prices are still going up, but it slows down the rate at which prices are going up. And then deflation is when prices go down. So what that means is we're not experiencing deflation. We're still experiencing inflation. And in fact, we're currently experiencing disinflation. Is that right? Did I say that right?
We're all like, Rabih, what do you think?
Yeah, no, it's right. Disinflation is when the speed at which the price level has been increasing slows down, but it's still positive.
And that's what we want. You're right. I mean, so ultimately, that's what the Fed has been trying to do this whole time is slow down, like Rabih said earlier, from a 6 to a 2, right? And what that means is we're not going back to 2019 prices. And if we did, I think it would be a bad thing. You think about shopping. Does anybody shop or buy anything that you need on the Friday, the week before Thanksgiving? I would venture to say no, because everybody's waiting for the week after Thanksgiving, which is Black Friday and Cyber Monday, and everything's going to be on sale. So people are going to wait to buy stuff until after. And so if people knew that prices were coming down or like next week, everything was going to be cheaper because deflation was happening, then it's going to grind the economy to a halt. And that could mean really bad things for a lot. There'd be a domino effect that would cause a lot of problems. So
it's really good. Really good analogy, very pertinent to what Thanksgiving around the corner. It's a really good analogy.
It's coming up. Amazon's deciding to do another Prime Day in October. So here we go again.
They are. Why not?
But yeah, curious to get your guys' thoughts on this, Rabih. I know this is probably more your area of expertise, but let us know what you think about.
No, I agree. It is like I'm just going to say it. A Big Mac is not going to go back to being $4. I'm sorry for all McDonald's lovers, but inflation is simply like the speed at which it's growing. And we, as Will said, we don't want it to be slowing like below zero. We want the speed to be positive because that incentivizes people and
wages to increase.
Exactly.
Incentivizes
the whole business cycle to keep evolving. But at the same time, because it's a speed, it's different than the price level. Once you get to a certain price level, you do not drop back from it. So yeah, it jumped from, I don't know, $4 to $5, but it's not going to go to 7, assuming. I haven't had McDonald's in a year. I don't know where I'm pulling these numbers from, but in a sense,
I think it's like 7 now. Yeah,
okay. I haven't had McDonald's in a while.
I haven't had McDonald's other than breakfast. Let's be real. Let's separate out breakfast from
different.
McDonald's. Yeah. Very different. I have not had McDonald's post breakfast for probably over 10 years.
That's amazing.
But their breakfast still slaps. Let's just be honest. Yeah. I have nothing more to add other than just kind of like reiterating that point, Will. I think it's such a pertinent topic to hit of this the difference in like, it's like raising the floor, right? That floor has now been raised and you're not going backwards. But I think this is a perfect example of highlighting why we're hearing this kind of when we're highlighting on this weekly of saying inflation's coming down, I think there's confusion for people because they see these headlines, they're hearing this podcast, the dozens of people that listen to us, and you're seeing it kind of across the board, and then people are like, but it doesn't feel like that. And I love that you highlighted this. It's because, what did you say, Rabih? Inflation is the speed, but that's different than the price level itself.
Yes.
The floor has been raised. It's not going back. And to your point, Will, we don't want it to go back.
Right. And it's less sticker shock now. Like, I think we've kind of, in a way, we've gotten used to the price. Like, we just know this is what it costs to do stuff now. And so I think there's less sticker shock, which is good from a consumer perspective because it is what it is and it's not going backwards. But it's also not like when you realize that I would say a year and a half, 2 years ago, and you're like, holy cow, I can't even go on a vacation anymore because it's like $1,000 more expensive than it was. Yeah.
Well, there's so much psychology behind this to that point, Will. It's so interesting to watch. And we're going to see this over the next year or two, I think, in dental specifically, this anchoring of like interest rates being in a good example here, where when you go from a 2.5% mortgage and it jumps to 5%, it's like, holy cow, this is insane. But now mortgage rates are up to in the sevens. Yeah. When it comes down to 5%, which it will, it's headed that way again. Like, they're coming down. We're already seeing this, at least specifically in dental. We just talked about this, Will, in the mastermind group, that we're seeing. I think Jake just said, was it his client that got a mortgage quote for like in the high 5s?
Yeah, I think it was like his brother. It was like 5.75 or something.
5.75 or whatever. Now 5s feel cheap. Like, it's so funny that we are now anchored to that high point. I think it's the same thing with inflation. Psychologically, we're all going to adjust if we haven't already. I think 2025, now that inflation's down, we're just all going to be used to the price levels. But that's a really good distinction. Rabih, you've got thoughts on this?
Yeah, like what you said, the psychological aspect is true. And also there's an economic underlying for it. A certain price level is very objective in a sense. Like, whether, going back to the Big Mac example, whether a Big Mac is $4, $5, or $10 doesn't matter objectively. It's just a number there. It's all relative to the real purchasing power of the consumer. So for the past year and a half, the inflation or let's say the real growth in wages hasn't kept up with the nominal increase in the prices of our goods and services. And for that reason, relative to the current purchasing power that we see, although inflation disappeared, there's still a big gap. There's a gap between our real purchasing power and the nominal prices of these goods and service. So the whole idea and the whole hope is that the inflation on these goods and services is in control. It's only at 2%, where our real earnings grow at a faster pace. So relatively and psychologically feel that they became cheap again. So a $10 Big Mac will feel cheap again once our economy has grown to a level where our purchasing power is so high that a $10 means the same as what $3 mean right now.
Yeah.
The goal is to have wages outpace inflation. And a little bit of inflation is good because it drives the wage increase as well.
Yeah, that's a good distinction. Obviously, COVID being the main culprit here of what created such a massive gap, and all the things that happened with the Fed, the printing of money, handing it out, like, that's what created a massive gap while things felt so crazy expensive. I love that, Rabih, that it's like the number itself doesn't matter.
Yeah,
it's
what it means. Could be a $20 Big Mac.
Could be exactly.
If our wages were up.
Yep.
Yeah.
Let's be honest. We're not going to go down this thread too far, but we are going to, I think, highlight the other part of this too. We've talked about the actual numbers. We've talked about the psychology. We'll just reference this. Like, there's a political aspect to this. Mm-hmm. For sure, meaning the narrative itself is going to be pushed and pulled depending on which side of the aisle you're on, of like what's going on with inflation. I think that's a huge factor, and it's only going to be louder and louder the closer we get to November. So
who you're voting for based on gas prices and food prices, and
the storyline is going to be, again, pushed and pulled in one direction or the other depending on who you're trying to get in office. That's just a fact. So this is great, Will. I'm glad you brought that up. Anything else? Any other final thoughts from you guys? Okay, let's get to the best one, I'd say. I don't want to pick
Hopefully
favorites.
People stuck around for this based on the tagline. Yeah.
They're like, what is that question? I don't want to pick favorites, but this is my favorite. No, I'm just kidding. Okay, so for some context here, a couple of things I want to give context to. This came from Ryan. I'm giving him a shout out. Sorry, Ryan, we took your topic. He wanted to do a full show on this, and I was like, I don't think this is worthy of a full show, but this is worthy of at least mentioning on 2 cents. So he texted this to me actually yesterday, and I was like, I have to talk about this. So shout out to Ryan for giving us this topic. The other piece of context I want to give is I was reviewing this with Rabih before. I showed him the original video, and I couldn't tell if you were mad, Rabih, or you were just like, there was some level of intensity coming from you that I wanted to address. So we'll address that later, your feelings. He literally just said to me, Will, he's like kind of got like what seemed like frustrated and then walked away. And I'm like, Rabih, you okay? He goes, I'm going to address it on the show. And I was like, perfect. Let's go. Okay. So the question being, do you even lift, bro? Okay. We couldn't think of a better question. I loved that question. Here it is. So somebody, I don't know his name. I'm sorry. I'll go back and maybe find or give him credit. Somebody decided to build a quote unquote, what he calls a deadlift ETF. Okay. It's not an actual ETF, by the way. He just picked companies under one specific factor, which is companies whose CEOs are very open about like lifting heavy or like really focusing on like fitness and putting it out there. So the best example here being Mark Zuckerberg or Jeff Bezos, right? Those two, I think those are the ones I think of when you think of this. So like the ones that are out there on social media, like posting.
Yeah, Bezos is a meathead. Yeah.
Bezos is a meathead now. And then Zuckerberg doing the same thing.
Yeah. He looks cool though. He's got the chain now and
yeah, exactly.
MMA fighting. Like
yeah, they're doing MMA.
Yeah.
So
he rebranded for sure since the sunscreen surfing picture.
Totally. So this guy basically said, let's put together a portfolio of these companies with CEOs who are very open about lifting weights or doing MMA or whatever. And he called it the Deadlift ETF. And there's only, I believe, 8 companies in it. So I'll list the companies. Meta, Amazon, Goldman, Uber, Microsoft, Apple, BlackRock, and NVIDIA. So these companies, and then they've tracked this over the last 4 years. Here's what's interesting and where Rabih's going to start fighting. This hypothetical portfolio has beaten the S&P 500 by 140%. So they said it's like 2.4x over the past 4 years compared to the S&P 500. So
outperforming Nancy Pelosi.
I think it's they didn't do a comparison to Nancy Pelosi. I should dig into that because the Nancy portfolio, we call that the insider trading portfolio. That might win. Rabih, we're going to go to you first because you were rearing. You were ready to go on this. I don't know if you were just getting jacked up to go to the gym or if you were mad about this topic. I couldn't tell.
No, I was mad.
Okay. Bring it. Let's go.
This is just the classical example of mixing up correlation and causation. Like correlation does not imply causation at all. And if you're the thing is, some people are going to look at that and believe it. That's what's bothering me. Like this is a very neat, well compiled way to make people follow a trend and lose money, which is what bothered me in a sense. Like, guys, if only you dig a little bit deeper and you'll know that you can avoid losing money on that. Like, this is what bothered me about it. I don't want to make people lose money on, I don't know, mathematically incoherent concepts. Like, I really want people to, if you're going to lose money, it's because you took a risk in the market and, it went the other way around. There's this analogy that I really like when it comes to like performance and like analyzing stocks. The analogy is as follows. Imagine you are at a top of the hill and you have all around you 360 degrees, different ways to descend from that hill downwards. There's going to be ways, or let's imagine skiing, right? You can either take the steepest, fastest way down, or you can take the, curve takes longer but gets you down further. In mathematical terms, those are called like principal components. So which one actually impacts your descent more than the others? The one that makes you tumble from the top of the mountain to the bottom the quickest is the one that impacts your descent the most. So the same thing with analyzing any source of return. That volatility or that growth in a return is really dependent on one or two or three principal components that really drive the return the most. And if I want to look at the performance of a certain stock and look at all the principal components, or the ones that create the fastest descent, in a sense, from the top of the mountain to the bottom of the mountain, and I list them out there, we can list so many. We can talk about the type of industry they're in, whether it's growing or not. We can talk about whether the company has a good market share and it's growing or not, whether the company's earnings are healthy or not, whether there has been any scandal in the corporate culture or not. And then after 500 different other principles, we'll say, does the CEO lift or not? So this is,
you know what? Here's the deal, Rabih. 99 out of 100 times, I'm going to go with you.
Not today.
This is the one. This is the one, man.
You're gonna die on this hill.
I'm going to die on this hill. I'm going to start. I'm deviating away from our entire philosophy after I saw this. It shattered my entire belief system around investing. And now this is I'm going all in on the Deadlift ETF. I'm sorry, Will. What are you?
Can I actually non-sarcastically?
Yes.
Yeah. Can I actually non-sarcastically kind of give a reason why I don't necessarily think this is? Obviously, I agree with Rabih. Correlation is not causation, but a lot of people all the time ask, well, like, what happens if the stock market goes to zero? Like, I'll have some clients ask that, like when we're talking about the growth of the stock market over the last 100 years, and the answer that I give is. I think that humans are wired to improve, right? Humans are wired to wake up. Most humans, there's some crazy people out there, but most humans are wired to wake up in the morning, go to their jobs, whatever their job is, and do good, like improve, like maybe try to level up or like get a raise or make it to another level of their career. I think the same thing for all of the Fortune 500 and big company CEOs. They're all driven by that same motivation, probably to even a greater extent than us. So maybe the ones who are ultra motivated and ultra, like, not only do they have time to run this massive company, but they also have time to get in shape. Maybe they're better CEOs than the other CEOs. Yeah. I don't know.
So Rabih's like, no. Okay, but here, I like this, Will. Let's obviously I'm being sarcastic here. I thought this was just kind of fun. This was kind of just a fun topic. Rabih knows I wasn't being serious about this. You guys know I'm not. But as someone who enjoys lifting weights and has been into fitness, I kind of saw this and I was like, this is awesome. I kind of love this. But I think there's a second, Will, kind of pulling on this thread a little bit that you just mentioned. If we're going to try to put an actual like reasoning behind this, I actually think there's another theory here. So I think every business, whether it be a small business or a large business, has seasons, right? And you need different leadership or different people on different seats on the bus. Think of a dental practice. I think like the founder of a dental practice, there's going to be a season that you need that founder, that creative energy, the thing that founder brings at a certain part of the business. But I think there's also a certain level of business you get to, or that company gets to, size and where it is, what season it's in, where you may no longer need that founder, right? I'll be honest, I'm thinking of Dentist Advisors as a perfect example. So I'm actually thinking, well, maybe these companies, these CEOs are actually showing that they've allowed their team and the new leadership to kind of like take over in that season that they're in. And they're off getting jacked. They're
just getting jacked.
Yeah, they're kind of like, you guys don't need me anymore. I'm off getting jacked. I'm not meddling in what you guys are doing. We're obviously stretching here, but I'm just trying to think of like where there might be some correlation here. But Rabih's answer is the right one, as always. There's correlation is not causation. I'm going to actually give you another example here. Have you guys ever seen? So what we're referring to is called a spurious correlation. It's things that are correlated that literally have no connection whatsoever. And if you ever want to have some fun this weekend, go to just Google spurious correlations website. Rabih, Will, have you seen this? It's hilarious. Okay, really, I'll just give you a couple of quick examples. So this shows you the randomness of life and how we love to tell stories about things like CEOs that lift weights lead better companies. We all know that's not really true. But here's a couple examples. Google searches for Taylor Swift correlates with fossil fuel use in the British Virgin Islands. It's almost like exact, right? Here's another one. number of public school students in 9th grade correlates directly with Bank of America stock price. Let's see. Let's see. There's a couple others I wanted to hit that were kind of funny. The distance between Uranus and the moon correlates with electricity generation in Japan.
Okay.
So you can literally just go through these spurious correlations. Exactly what Rabih's highlighting. Like, there's no real correlation here unless we're going to actually stretch on this. But
I mean, the guy basically bought like a more focused NASDAQ portfolio and called it a deadlift portfolio.
If we let's just hit these again: Meta, Amazon, Goldman, Uber, Microsoft, Apple, BlackRock, Nvidia. So it's like, congratulations.
Just bought a bunch of tech companies. Yeah.
Exactly. So anyway, Rabih, are we feeling any better after we'll give this to you? Okay. We were just wanting to have some fun. Any final thoughts? We'll give you the final word. As someone who also lifts weights, Rabih, you like lifting weights.
Dude, you told me I'm jacked the other day, and honestly, I was at the gym earlier that evening, and it made my day. I've hit a PR. I was like, this is the positive feedback reinforcement that I need in my life.
You looked great. I'm just telling you, the fit was.
No wonder our investment returns are just ripping off.
Yeah.
There you go.
Exactly.
That's the cause correlation.
Okay. The takeaway here is the catchphrase of the day is, go lift weights and your life will be better. I actually do agree with that. That is something I actually do believe. Any other final thoughts? Will, Rabih? No?
All good.
Okay. If you made it this far in the podcast, thank you so much for listening, as always. If you want to talk to us, whether that be about lifting weights or your situation, we'd love to hear your story. We'd love to be able to help you out. dentistadvisors.com. Click on the yellow book free consultation button. We'd love to talk to you. Will, Rabih, as always, thanks for being here. Everyone, thanks for listening. That was our 2 cents. Till next time, have a good weekend. Bye-bye.